All right, I'm going to turn my camera on so it doesn't look like I'm frantically. There we go. All right, so you guys don't have your camera on. I wish you did. I could see everybody, but I've got mine on up in the corner here. So good morning to you. Let's jump right into this. There we go. So guys, I will just remind you that as always, we are never going to be giving you direct advice with regard to specific trades. The disclaimer is in there for a reason. And my title bar is covering up. There we go. Booyah. All right, just confirm, are you guys seeing a full screen with the that's what we should be seeing right there. Okay. You should be seeing the disclaimer now, correct? Well, it says that you are. Let's try this again. We want to be looking at this. How about now? Okay, very good. All right, so just a recommendation, guys. Before you consider any positions, you should be fully informed. You should not be taking any advice from any classes that we teach here in this format on any particular trades. Trading does involve risk. This is educational. We will be looking at charts. We will be looking at situations where a person might want to trade, but we're not giving you any advice on a specific trade. This is educational only. And with that, we remind you, as always, that there is a ton of stuff coming up. Rob does an amazing job of doing content and keeping this always interesting. And we've got some new events coming up, as you can see. I love that jacket. I think that's pretty awesome. Anyway, we are now going to shift over to, let's go, is that right? Yep. All right. So I shifted over to a different slide. This says market correlation. And let me just double check on this. You want to see, well, that's the one we're on right there. So is that what you're seeing? You're seeing market correlation on the slide right now? Perfect. All right. Okay, guys, we're going to spend our instruction part this morning talking about this principle, and then we'll switch over to charts, and we will do a charting session as we've been doing recently, and I'm looking forward to that. I love it. But this is a very interesting principle. When markets are going to get have periods of volatility and then slack, there is something that if you're not aware of it, guys, you need to be aware of it. And if you, oh yeah, I've heard about that. Yeah, okay, that's not enough. It's something that you need to have as a tool, and you need to have it constantly available to you, because there are things that can sneak up behind you. And in martial arts, there is a phrase that says, the punch that knocks you out is the one you didn't see coming. Okay. It's not the one you saw, it's the one you didn't see. That's the one that knocks you out. And so if there's something going on that could have an impact on your trading and you're not even looking at it, you're not even on, it doesn't even on the radar. It's not a tool that you even have in your belt or you have any idea how to use. That's the one that's going to eventually catch up with you. Okay. Yeah, you're saying it's not in full screen, and it looks that way to me too. So let me just try this again. It says from the current slide, resume slideshow. If anybody knows a trick on how to make this go full screen when it's not, I am, see, optimize compatibility. I'm at a bit of a loss as to why this is going up in full screen mode. Anyway, if you can see it, if you can read it, we'll muddle through it. If you got a quick answer, give me a quick answer. Otherwise, we'll keep going. I don't want to waste time on this. All right, correlation. What is correlation? Correlation is a statistical measure that determines how assets move in relation to each other. If you've seen a swarm of birds flying through the sky, sometimes they will fly in such a synchronicity that it is mind-boggling. A swarm or a big flock of birds will move, but they move as if they're all tethered together. I'm seeing this now being done by humans, which is fascinating when you see drone herds or drone flocks with lights on them doing light shows. They can do things that are just absolutely mind-boggling now. If you look up in the sky and you'll see 100 drones or 500 drones, and they're all operating to create these images up in the sky and moving and shaping and changing and morphing into beautiful configurations. It's amazing. Well, birds do that, and markets do that sometimes and don't do that sometimes. Sometimes they're just a flock of birds that are just kind of randomly going in every direction, which means they're not much of a flock anymore. And other times it's like they're all tied together with the same brain. And this is what we're talking about in terms of correlation. It can be used to measure general market correlations, such as how asset classes move together, or broad markets, where you look at broader segments of the market and how they relate to each other. Correlation is measured on a scale of -1 to +1. And so you'll see numbers that are like 1, which would be a perfect positive correlation. That means everything is moving exactly the same way, the same direction today, yesterday, tomorrow. The markets are just in sync with each other, perfectly in sync. And you could have a -1, which means there's no correlation. Whatever you're looking at, if you're looking at it compared to another stock, another index, another market, and they absolutely have no correlation to each other, that would be a -1. So -1 to +1, that's going to be a correlation. 0.5 would be, yeah, it's semi-correlated, right? It's neutral. It's hard to tell if it is or if it isn't. All right, that's what it is. Now, here's what it tends to look like. When you make it visual, which I am big in visualization, I'm big in charts, big in visualization, big in being able to spot trends, correlations, patterns, things like that. I love that. Market divergences can only be, well, not only, but they can be best seen visually in a chart. Now, you could put a wall of data together, and somebody like Rain Man, the Rain Man, could look at that, a savant, and see patterns in it and go, wow, I'm impressed. I can't do that. That's amazing. Maybe accountants can do that. Savants can do that. But for most of us, visually, you can see whether or not there's a correlation or not. And in this, you're looking at the US versus Japan, the US versus Europe, the US versus Asian, minus Japan. These are stock correlations over 100 years. Okay, 100 years, not quite. Not quite, 30 years. Okay, and you can see, wow, that was a unpleasant sidetrack there. Sorry about that. But here we go. Um, okay, so we had perfect correlation in 2011. It was difficult to pick stocks that outperformed the broader markets because everything was correlated. nothing is going to outperform if they're all doing exactly the same thing. It was also hard to select stocks in different sectors to increase the diversification in a portfolio because there was no diversification. They all went up, they all went down. So investors had to look for other types of assets to help manage portfolio risk, and it got very creative in that point. Now, this is the aftermath of the market corrections in 2008, 9, and it took a while. And then when it started to come back, there was this powerful correlation that lasted for a while. On the other hand, the high market correlation meant that investors only needed to use simple index funds. And so there was a period of time where a financial advisor just threw up their hands and said, you know what, everybody just buy index funds, buy the S&P, because it really didn't matter what you did. Okay, so that's the nature, that's the impact of correlation. It is something that's real. It's something that you need to be aware of. You need to be able to understand that it does impact you, and you may not even know that it's impacting you, but it does. So correlation and volatility. Correlation will increase when volatility increases, right? So when people get scared or they get overexcited, either way, and the markets start to go up, markets start to go down, the more volatility there is, the more correlated the behavior it is. The more excited people get, and they all start to move the same way, either positive or negative in terms of fear and or excitement. Okay. You might find a lagger or two. There's always one or two that don't follow the herd, but for the most part, you get this high correlation. There are websites that list correlation. They give numbers, but for traders, guys, the best tool is going to be charting. And I'm going to make the case that pretty much all of us are more powerfully driven by vision of patterns than we are of pulling data out of number sets, a big wall of number. Like I said, the Rain Man can do it. I can't. So when you're visualizing correlation, what you got to do is you want to choose to overlay something on top of your charts. You put one chart up, then you put another one that overlays on top of it. And with that, you can get almost instant analysis of correlation. Okay. You can do one-on-one with stocks. You can put sector comparisons together. You can compare markets. You can do all kinds of things, but they got to be relevant. You don't want to compare data from 1965 to data to 1980 if you're looking for correlation, unless you're very careful to make it so that it's relevant. It's got to be relevant. And for the most part, it's going to be real simple. You're looking at the behavior of the last 6 months, the last year, the last 2 years of the same 2 items or 3 items or 4 items that you're trying to compare. Okay. Volatile markets need to be evaluated for correlation. So when you do get market volatility, you want to know if your stock is going to behave the same way as everybody else, or if there's something in the past that would indicate a different type of movement, a different type of behavior. So you want to look back. You always look back for historical correlation or historical comparisons. And you look for leading or lagging correlation. In other words, what I would look for is there something that when they were all correlated, is there a sector, is there a particular stock that tends to break away from the herd before the others? In other words, maybe it's a leading signal. Maybe it's the first one that starts up when everybody's heading down. If you've seen that in the past and you start to see that in the future, it gives you something to work off of, right? These are just patterns. They're patterns that you should be able to recognize with your eyes. When I look at a wall of numbers, there can be patterns. And if somebody spends enough time showing it to me, oh, okay, I can see it. But man, it takes a lot of work. When you're looking at data in rows and columns, my eyes kind of gloss over and I can get it, but it takes a lot of work. What works for me is pictures. I like charts. I like pictures. I can read those things quite easily. Okay, so key points. Correlation is statistical. It's very common. The summation on this, guys, is that traders can use correlation, but we're going to use it visually, and we're going to use it as a tool to measure divergence or convergence or correlation. right? So correlation would be positive correlation is full correlation. We have divergence and we have convergence. Divergence, it needs to be used as convergence and divergence. Divergence means the things are taking off in different directions. Convergence means they're moving towards each other. But what that means is that they're not correlated tightly. They're correlated negatively if they're going opposite directions. For traders, we want to be able to look at things like this. Now take a look at this chart here. This is the one that one of the ones we were looking at earlier. This is a using the S&P 500, comparing it to the Australian and the Japanese pairing. So this is a weird pairing because you're looking at commodities as opposed to an overall market. But you can see that there was real tight correlation there for a few months. And then it diverged, not converged, diverged. And then it converged in the green. They got back together, and now they're back in sync. That is something that would be very, very powerful if you were trading anything that you cared about its correlation to the S&P 500, right? I mean, that's just that is a strong correlation. Here you have $1 million home sales compared to markets. So you can compare apples to oranges as long as they're in context. And you can see that during a period of time where you had high volatility and movement in the price of houses, you had a similar correlation with the S&P 500. But the housing prices were running away from the market. Okay, they were both going up, but you were accelerating faster than the markets. And then when the markets corrected, you have a market correction at a certain percentage. You had a housing correction that was a larger percentage because it got back to a set point. And at that point, they began to move together again. So when you see a separation like this, and you've got a historical reference back to 2007, 2008, if you looked at today's correlation between housing prices and the market, you would see that they're kind of pulling back after having had a similar separation. We had a huge run up. And then we had the last year and a half, well, last 2 years, the last 2 years where things changed, well, a year and a half. And you had a big correction in housing prices. And now you see markets going again. So in correlation again. So this is the kind of thing that you look for. There's patterns. History has patterns. And it's significant to recognize that this exists. Okay. What you're looking at here is periods of time where you have big pullbacks in a group of stocks versus the S&P 500. Okay. Everything to me can be understood if there's a picture. If I can see it, I can see correlation. I'll never forget, guys, the time that I had been harassed. I'll say harassed by, I don't know, I got on somebody's list and I had commodity guys calling me. And they were saying, "Oh, give us 10,000, give us $20,000, give us $50,000. We'll make you a whole bunch of money in oil." And I said, "Well, okay, I don't trade oil." "Well, we'll do it for you. Just send us some money. We got a great track record." And I said, "Oh, well, okay. We can talk. This is kind of interesting, but I don't know anything about trading oil." And I said, "Do you have any charts?" "Oh, yeah. So I had, send me some charts." And I looked at the charts and I looked at their correlation. And I'll never forget when I looked at it, I still didn't know what I was looking at, but I started pointing out discrepancies based on what they thought the oil was going to do. I said, "Yeah, but look back here a year and a half ago, what happened? It looked just like today, and you did not get the move you're talking about." "Oh, yeah, but our analysts," I said, "Okay, so what about 6 years ago?" And I started pointing out patterns. I said, "Look, I don't know anything about trading oil, but I am not putting a dime with you guys because you don't have a clue. You can't even look back and see patterns." Well, obviously, the guy's a salesman. He's reading off a script and somebody's telling him what to do. And they'll tell him to say anything to bring money in. It wasn't about whether we were going to make money over the next 6 months or 4 months. It was about, we need to bring some more money into our fund, right? So that's the thing, guys. There are patterns there. Correlation is best used when it can be visualized, when you can put it on a chart and compare things. And you can see this even if you didn't know what this was. This is Consumer Price Index and the S&P 500. Is there correlation? Yeah, sometimes. Is there divergence? Yes. Is there convergence? Yes. Sometimes it's correlated, sometimes it isn't. So could you use Consumer Price Index as some kind of indication to help you understand how the S&P might behave, or vice versa? And the answer is, yeah, you could, if you could go back in time. And this goes back to 1935. So you could go back in time and you could see patterns. And then would it be relevant? Maybe. It would only be relevant if you could lay it on a chart for today and see that we have a similar setup that we had 1975, 1942, 1995, whatever. If you can find a sequence that matches that, it could give you a very powerful heads up. A very powerful heads up. And guys, this is why I think there are certain people that tend to be consistent in calling out market corrections. It's because they look at enough data and they see correlation, and they say, you know what, if it walks like a duck, talks like a duck, quacks like a duck, right, swims like a duck, flies like a duck, it's probably a duck. I mean, we ought to be paying attention here. And correlation is a tool that you need to have. In my opinion, it's a tool that you need to have. Okay. All right. So I'm going to stop the share, which will take us back to the basic screen. And we're going to, let's see. Jennifer says, how can we do overlay like that? Well, I'm going to show you. We don't have a lot of time. We only got a little less than 20 minutes, but I'm going to show you how to do this. Okay. Oh yeah, right here. So let me do the screen share. We're going to pull this up, and you're going to tell me. Get over here, close that out. All right. Okay. All right. You can see the charts right now. And I am just curious why I can't see where's the chat? I've got to get it to where I can see it, guys. Just a second. How come I can't see the chat?
We see the screens. We see your charts.
Thank you. I couldn't see the chat, so thanks what I needed. Okay, so to answer the question, how do I do this? How can I see this? On your keyboard, there's a C. And so I'm going to click on the C, and it says comparison symbol. All right, we have Amazon on the background right now. So you have some options. You can display the bars. You can overlay as bars in the price. You can overlay as a line chart, right? Percent change comparison in a new chart. No. We're just going to overlay it right here. So we need a symbol. So we're going to click on OK, and it's going to say, what do you want to compare on here? Well, let's see, we got an Amazon there. How about we do Google on there, and we say, let's compare Amazon and Google. All right. So now we're going to go and we're going to, let's see. There we go. So now you've got Google in that line. And if I click on this, come on. I'm trying to highlight Google there. Okay, there we go. So you can see that you have a pretty strong correlation last year through 2003. They pretty much moved together. Sometimes Google would outrun Amazon. but for the most part, they moved together. Now you had back in October, Google took a little bit of a dip, Amazon took a bigger dip, but did it recover? Yeah, sort of. You can see that Google bounced right back up very quickly. Amazon, on the other hand, struggled. It had a nice double bottom, tried to rally up, put in a lower low. At the same time, Google took a big hit, and then they're back in correlation. So Google was doing really good there for a while, outperforming Amazon. And then there was a correction in October, the end of October, and they both went down. But because Google had been hyped up a little bit more, Amazon didn't have as far to go before it reached equilibrium. Google had to go a long ways to reach equilibrium. Both of them reached back to a point where they were in correlation the previous June. Okay. Then they start moving pretty much together. Google gets a little bit more volatile, but not so much. It's basically they both throw a double bottom there. They rally up, they pull back, they move together, and then boom. Starting the beginning of this year, Google takes a big hit. Now, this is news driven. Amazon launches into all-time high territory, keeps going, keeps going. Google finally gets over their issue, pops back up, and now you can see they're basically in sync again. So what value is this? I don't know. I don't trade these two together. But if I was trading two tech stocks that had a very high correlation and they didn't have wild departures like Google and Amazon do every once in a while, then I could be playing two stocks for the price of one, right? Maybe one's moves bigger. Maybe one on an average day moves, or a week moves 40 points, 50 points, and the other one averages 20 points. Okay, well, they correlate, and I could trade in both of them or either of them. But if I'm going to trade them for a week, on one, I could get an average of 50-point movement, and the other one, I'm going to get a 20-point movement, and they're both the same. You see? Now I can say, I can trade both, or let's just trade the bigger one. Let's ride the bigger horse. They both go together. So if that's the case, let's just ride the bigger horse. You see? That's how you could use that to make a decision. Okay? So I am can I ask the because for some reason I can't get it to show. I don't even have the I oh, there we go. There we go. My bad. I just figured it out. Thank you. All right, so somebody give me another stock you want to look at. And we'll get rid of the comparison, but give me another stock that you want to take a look at. SPY. Okay. So we're going to do comparison here, and we'll do the SPY, but I want to now, let me get the edit up here. There we go. Okay, I think, let's see, let's turn this. Hang on, give me just a second here. All right, I've got to move my heading out of the way so I can see. Get rid of that. Boom. There we go. All right, now we have a nice little mess here. What we want to do is bring up the All right, guys. Sorry about that. Something that was working earlier is not working. Let me go back to Amazon, put Amazon on there. And this will work. Here we go. So we hit the S button. And I'm wondering if this delaying on this is coming because of the internet. So if we're having internet problems, because I'm having keys that not responding, so it's delayed. All right, so what we have now, guys, the SPY is in the candlesticks, and the comparison on that is in the line chart. And that's where Google comes into play. Okay, so now we're comparing Google with Amazon, or excuse me, with the S&P 500. So, all right. So we want to put SMCI, that's the next request. We put SMCI on there. And we want to all right, see, so what's there we go. Okay, so now you're looking at SMCI, which is that line that just appeared here. And guys, what normally happens is when you right click on this, when you highlight the stock, it'll bring up what you're looking at, and you can change colors and shape and the line, the thickness of the line. Right now, I've got a default coming in here that I don't seem to be able to change, and it should be able to. Normally, it does. I can't explain it, but I'm just not getting cooperation on the keyboard here like I normally do, and it may be this internet problem. I don't know. Anyway, so if you look at the line that just popped open there, SMCI does not correlate very well with the S&P 500. Sometimes it does, sometimes it doesn't. Right here, through the October through January, no correlation, negative correlation. Then you have convergence where it's suddenly catching up. They're both going up, but this is going up much faster. So this would be a high correlation, but not in sync. Then it turns around and starts to follow it for about 2.5 months. Then it drops away. And right now, I would say there's a loose correlation, but this is not consistent. Okay, pick another one. Let's see if we can get this to relinquish. If anybody sees something that I'm missing, you're welcome to tell me. But normally, you can highlight the individuals on here, remove them, change the line color and thickness, and whether it's candles, and we're just not getting cooperation here. Let's see. Nope. Even clicking on the underline, which is the S&P 500, not getting any control windows. Interesting. Okay, so we're going to change our base here. And let's put it on Google. Is there any correlation with Google and SMCI? Nope. Can you right click on the line that you want to remove, then hit delete? Yeah, that's what I normally do, and you can't do it. See, when I'm right clicking, it doesn't bring up, let's see. I have the edit chart settings option that pops up there, but that's not the individual stocks. You should be able to highlight and bring the stock yeah, I don't have the controls that would normally show up here, where you can control the stock or control the imagery. Well, this is the day we're gonna have to chalk up to where we had issues. You can put on as many things as you want. We're apparently having difficulty taking them off. This is one way to do it right here. Is that going to work? Yes, it is. All right, finally showing up. What happens if we do that? There we go. All right, well, you can see up here in the top, I have a list of all the things that are being viewed on this particular window. And yes, I could have gone to a different window. I was just frustrated that this wasn't working. I was sure that if I hit the right button, it would work. Interesting. That function is still not working. All right, so let's change this. And I'll try one more. We got time to do one or maybe two more. So I'll put the SPY up there as a default. Okay. All right. Anybody want to see a comparison with another stock, or do you have something you want to chart? Because we can do either one. All right, let's put Meta up there just for heck, for grins and giggles. All right, so let's zoom in on this a little bit. So how much does Meta correlate with the S&P 500? Well, you see it right there. It's pretty tight. It's pretty tight. Your divergences are not significant. You have rate of speed, but from a direction standpoint, you have a very, very high correlation with Meta. All right, their individual speeds will separate a little bit, but direction doesn't change. They're going around the same racetrack. They take turns being in the lead. Sometimes they're tied running side by side, but they're both running around the same racetrack. That's the way I would put that. Okay, so we'll go up here, we'll right click and delete Meta off of there. COIN, put coin on there, and let's do a comparison with what? Do you want to do coin with S&P 500? Is that, Brenda, is that what you want to see, or what? What do you want to compare it to? Yes, okay. Okay, so coin is in the darker, it's in the candles, and then you see the S&P 500 in the line chart. If we go back and look at a couple of years on this, Brenda, that would be the most important thing. Is I always want to start with a bigger picture. So I look back here and say, in general, do they correlate? And the answer is, yeah, they do. Now you go back in 2022 and you see the rate. They're still going around the same racetrack, but the coin kind of outruns the S&P in whatever moves it's making. And then it goes back to where they're in sync. And now we have the first time in the last couple of years, but if we look back farther and we lose a little bit of the relationship, but you look back here to see if there's any big examples of change. And there is, if you go far enough back. And what we're seeing now is we had a period here from February to just recently, right? The middle of April, where you had opposite direction. You know, the market was moving up strong. Coin took a big detour. So there's negative correlation, divergence, and then it looks like they're kind of coming back together again. Interesting, huh? So guys, it's just one more tool. It's a tool in your arsenal. And if you want to find out if you are tracking the markets, or if you need to be paying attention, if the market starts to get volatile, your question might be, uh-oh, what does this mean to me? Well, go back, compare them and look back. What happens when the market gets volatile? Does your stock get volatile? Does it go the same direction? Go the opposite direction? It's one more tool. And I am the first one to tell you that I don't like seeing 10,000 indicators or even 1,000. There's not 1,000, by the way. But I don't like see people using 10 indicators or even 5 indicators. It's too many. It gets too muddy. But if you've got an arsenal, if you got a few in your tool belt, you may not use this very often, but when markets start to get a little wonky, if you start to feel like, hey, things aren't working the way they used to work. I'm not quite sure what's going on. Throw this out. It's another tool. Pull up the comparison feature, hit C on the keyboard if you're using Omega charts. If you want to pop in here and say, I want to compare it to, that's how you do it. It's that simple. It's that simple. And then you go up and you remove it when you're done. But guys, it's one more tool. It's something you should have in your arsenal. All right. Hey, guys, thanks. It was fun today. I apologize for the technical difficulties, but apparently up here in the Northwest, we had a few glitches this morning. Take care. God bless. And we'll see you next time. Bye-bye.